He also represents insurers and investors in venture capital, private equity, private placement transactions. He graduated with honors from the University of Florida College of Law. He's got a bachelor's degree in history, political science, and he's a member of the Florida State Bar. I think the topic is really appropriate to things that go on here at the university with technology licensing and startup companies that we deal with. So with that, I'm going to turn it over to Curt.
Great, thank you. And thanks for having me today. I assume everyone can hear me okay. You know, as the introduction indicated, I always say that I'm a lover, not a litigator. That's the type of lawyer I am. I help put deals together, form companies. When litigation happens, my firm has hundreds of litigators that I can send the matter to. That's just not what I do. So what I do is I help companies from the incorporation stage all the way to the sale or public offering stage and everywhere in between. And so what we're going to talk about today is something that virtually every startup company and every early stage company has to face, and that is, what do we do about equity? And so we're going to talk about that. This is just going to be a very practical overview of the topic. And at any point in time, if you have any questions, just raise your hand and pipe up. We can keep this relatively informal since there aren't a whole bunch of us here. And if I'm going too fast or I'm glossing over something that you want to explore more in more detail, let me know. So I think what we're going to do is kind of divide this up into three categories of topics here, and that is, we're first going to talk about some of the key terms and concepts associated with equity. Then we're going to talk about how do we grant and allocate equity in startups, and then we'll talk about what are equity agreements and what sort of provisions do they need to have. And these are all very important topics, and if you're involved with startup companies or early stage companies in any matter or degree, these will be topics that you'll have to that you will come across. So let's talk about some key terms and concepts, and this is really the place to start because it demystifies equity. A lot of people think that equity is kind of a complicated topic, and they hear all these terms like pre-money valuation, anti-dilution rights, preferred stock, liquidation preferences. They hear all these terms and they somehow think that there's something really complicated. Now, equity is really kind of a simple concept, and it's just getting some of the lingo down. And in very basic terms, equity refers to the ownership interest in a company. In other words, what's left over after all the creditors and all the debt is paid. And that is, if you have a company that consists in a variety of tangible and intangible assets and is a going concern, and you sell those assets and you pay off your creditors and you pay off your debt, whatever's left over is kind of the equity of the company. So a lot of times we talk about it in terms of it being a company, what its equity value is or residual value is. If a company's worth $12 million and has $4 million of debt, well, its residual value, equity value is $8 million. So equity kind of refers to the ownership interest as a whole, but kind of when you break it down and when you denominate it into specific units, equity is often used to refer to stock or shares or membership units. And stock and shares and membership units are merely what you get when you take that equity and you divide it up into chunks among the different owners. So when we talk about an equity security or an equity interest, we're merely talking about stock. Stock and shares, essentially the same thing. Some states like to use the word stock. Other states use the word shares. Some states use both, but it's essentially the same concept. When you hear we talk about membership units, that's the equivalent of stock in a limited liability company, because a lot of startups are forming as limited liability companies these days. And while that's beyond the scope of this particular topic, there are a lot of good reasons why you might want to form as a limited liability company. That's a whole separate presentation. In accounting, you'll often hear accountants talk about the word equity, and that means something slightly different. And that is, when you look at a company's balance sheet, that really means kind of what's left over after you take the assets on the balance sheet and then you deduct all the liabilities. That's what's called owner's equity. And like for example, if you look at a balance sheet of Newco right here, you'll see what their assets are in the left-hand column, and then their liabilities are in the upper right hand column, and then you'll see what their shareholders' equity is, which is actually the balance of the assets minus the liabilities. And so a lot of people think, well, geez, if I look at that, that's what a company's worth. And for example, in the case of Newco, the company, since it's $200,000, that's what the company be worth. Not really, because when accountants prepare balance sheets, they don't book assets to the balance sheet at whatever the value is. Well, they do at whatever the value is or whatever the purchase price is at the time the asset's acquired. But the assets on a balance sheet don't reflect appreciation in those assets. They don't reflect the going concern value of a company. So if you hear an accountant talk about retained earnings or shareholder equity, that's something slightly different than what bankers or investors or lawyers will say. So just keep that distinction in mind. A few other key distinctions we'll talk about are corporations versus limited liability companies, just two different types of forms of entity. Stock or shares versus membership interest. We talked about that a moment ago. And then board of directors versus board of managers. Board of directors is the governing body of a corporation, while board of managers is what we typically call the governing body in a limited liability company. Although in a limited liability company, you can call the board anything you want. And in fact, you can designate yourself as the board and call yourself the grand poobah and give yourself all the authority in a limited liability company. Completely legal, completely legitimate. So let's talk about some important terminology specifically relating to equity. And a lot of times people will come to me and they say, okay, how many shares do we have, or how many shares should we have? And that's kind of a question that has lots of possible answers. And I can't explain why it has lots of possible answers until I introduce you to some of these terms. So some of these terms, for example, authorized stock and authorized shares. Whenever you form a company, there is a cap on the number of shares you put in your charter. And you say, okay, this company is authorized to issue up to 1 million shares, 100 million shares, whatever you put in there. That's authorized shares. That just means the number of shares that the company under its charter is allowed to issue. Doesn't mean that it's actually issued those shares. So for example, if a company is authorized to issue 1 million shares, but only 1 share is granted, and that share is granted to me, I still own 100% of the shares because I'm the only one that holds shares. Issued and outstanding shares are the shares that are actually issued and granted. In the example I just gave, we have 1 million authorized shares. Only 1 share is issued and outstanding. Typically what happens is when people talk about percentage ownership, they talk about what percent do I own of the issued and outstanding shares. Authorized shares really isn't that significant. It's just a cap is all it is. And you can change that cap virtually any time. It becomes more significant when a company gets larger and is public, but for a startup, it's just not that significant of an issue. Now, I also want to talk about what options and warrants are. You'll hear lots of people talk about options and warrants, and a lot of people assume that they're really different things. They're kind of really the same thing. It's just different terminology is used depending on the context. An option is a right to buy a share in the future. At a price, and there's an option agreement, and it says you're hereby granted the right to buy X number of shares at Y dollars per share up until a certain date, and that's an option. Warrants the same concept. Typically we use the word option to refer to rights to purchase shares that are granted to employees or service providers. Warrants are usually the same sort of thing, but they're granted to investors. So those terms are kind of interchangeable. A term I don't have up here, which we'll talk about a little bit later, is a term called a convertible security. And a convertible security is like a note or some sort of debt instrument that the holder can convert into shares by virtue of its terms. So I can grant you a promissory note. You can loan me $100,000, and that promissory note can say that the holder of the note has the right, in lieu of getting paid, to convert that to shares. That's what's called a convertible security. What you need to keep in mind regarding options, warrants, and convertible securities is what they are is they're a right to buy an unissued share. So you have a bunch of shares that the company's authorized to issue, some that are issued and outstanding, and some that aren't issued. So options and warrants and convertible securities give you a right to acquire authorized shares that aren't yet issued. Now there's a concept called fully diluted shares, and this is a really important concept because it really, in order to understand and learn how to grant equity in a startup, you need to understand this concept of fully diluted shares. Fully diluted shares are really how an investor looks at your capital structure. And the fully diluted shares are your issued and outstanding shares plus the shares that are underlying your outstanding options and warrants. So say, for example, you have 100 shares issued and outstanding, but you've granted an option to sell an additional 50 shares. Well, your fully diluted shares are then 150 shares because it's what you have outstanding, but what someone else can acquire as a result of some contract right, like a convertible security or an option or warrant. So fully diluted shares, we'll be talking about that a fair amount. Par value, you'll often see shares when you form a company that will say common stock, par value 0.01 per share. Don't ever worry about that term again. It's antiquated. You don't even need to do it under Florida and most other states. When you form a company, you can have no par value stock. Par value, in case you're interested, par value was a concept that said that a company could never ever issue shares at below that price, but it doesn't really even apply anymore, and that's why par value is always really, really low. Sometimes people think whenever they see the word par value that that's somehow the value of the share. It has nothing to do with the value of the share. Did you have a question? Oh, I thought you raised your hand. I'm sorry. So now, just keep in mind also, when you talk about debt instruments, like if you see bonds or notes, when they talk about par, that actually does have meaning. With stock, par value means nothing. Just forget about the term, and if you ever see it, just make a mental note. You don't need to know what it means. Capitalization merely means the breakdown of the capital that's been contributed to your company. So, some people may have contributed money in the form of a loan, debt. Some people may have contributed in the form of preferred stock, common stock. That's kind of the capitalization. And then the capitalization table, aka the equity table, is really a table that sets forth what your equity structure is. And let's take a look at a sample capitalization table for NewCo here. So NewCo here, relatively simple company. We have some issued, the first column shows issued and outstanding shares of common stock. Founder 1 and 2 have some shares. A seed investor came in, has 10,000 shares. The seed investor, it looks like that seed investor got some warrants to purchase 1,000 additional shares. That would be 10% warrant coverage. So the investor in the middle column, shares underlying options warrants, has 1,000. Director number 1, a member of the board, to incentivize that director to come to the company, we granted her an option to purchase 3,000 shares. And then director number 2, we also granted her an option to purchase 3,000 shares. So what you'll see is the actual number of shares issued and outstanding are 50,000. The number of shares underlying options and warrants are 7,000. Fully diluted shares, 57,000. Pretty simple concept, not really hard at all. In NewCo, the authorized number of shares is 1 million, but it's kind of irrelevant because it really doesn't show what the relative percentage interests are. Par value is 0.01 per share. Who cares? As I just said. And then, so the real important numbers are the issued and outstanding shares and the fully diluted shares, because that's what people are going to focus on. So here's some important things to remember, and that is there's really no magic to share numbers. I get this question all the time. So in my startup, I'm thinking that we should have 1 million shares outstanding, but one of my advisors says that it really should be 10 million, and someone else says it should be 10,000. And my answer sounds kind of flippant, is, well, who cares? Because it doesn't matter in absolute numbers how many are outstanding. It just matters how much you own relative to the number that are outstanding. So ownership is more important than share numbers, but then again, ownership percentage doesn't indicate value, right? You may own 50% of a company that's worth $1 million versus 1% of a company that's worth several billion. What would you rather have? The answer is easy. Share numbers are just how is the pie split up. There is no right or wrong number. And by the way, A lot of companies think, well, geez, I want to have this many number of shares so that if a VC or an investor comes in, I can issue this many. Most investors, savvy investors who have the sort of money that you want, and most VCs, that's irrelevant. And by the way, if for some reason they don't like the share numbers, there's always a very easy answer, and you do what's called a stock split, which can be done very easily, and you just change all the share numbers. Not difficult at all. The important thing is not share numbers, not even really percentage ownership, but it's valuation. Valuation is everything. Equity's worthless unless ultimately there's going to be some sort of exit event or liquidity event, such as an IPO, a sale of the company, or perhaps a significant distribution. So ultimately, the value of a company is driven by ultimately the equity markets, because then the equity markets determine the value of the M&A markets. And so we ultimately look at really kind of market comps out there to determine what the value of a company is. When I say market comps, market comparables, and that is, so what are similar companies with similar results trading at in the equity markets, or what are they getting bought and sold at in the M&A market? So whenever I talk with a client about setting up the equity structure, I always kind of work backwards and say, okay, if this company gets sold, say, a year and a half, 2 years, which is not uncommon for an early stage company, sometimes they get sold pretty quickly, what do I want the large S, the residual value of the company, how do we want it to be split up? And that's how we kind of back into the equity structure we want. And so what we often do is just make some basic assumptions on, okay, what might be the size of a liquidity event? Is it going to be in the millions, tens of millions, 100 million? We kind of look and try to get a sense of what might be the value of this company. And the way you determine that is based on valuation principles that investors and investment bankers utilize. Now, as a lawyer, I'm not an investment banker, and I am an investor, but if you really want to make a lot of money, you should sell short everything I invest in, because you'd make tons of money. So I guess I am an investor in that way. It's ultimately the public markets out there and the M&A markets that determine value, and therefore it's investors and investment bankers have a sense of what the value of a company should be, and we'll talk about different valuation principles in a second here. It's important to have a general sense of what valuation principles are and what those concepts are when you discuss equity grants and allocations. You don't need to be an expert in valuation because they're that's their job, but you need to have a general sense of some of this terminology. So here's your crash course in valuation, and I'm going to try to keep it to 2 or 3 minutes. Your crash course in valuation is, first let's talk about what do we mean when we talk about fair market value. Fair market value is generally defined as what a willing buyer would pay a willing seller in a voluntary transaction in which neither is under compulsion or obligation to buy or sell. Hardly a scientific formula, and that's what you'll learn about valuation, and that is, while there are experts out there that may treat it as some sort of a quantitative science, it's just not. So that's the general definition of fair market value, and here are some ways that companies are sometimes valued. Their fair market value is determined. They might be determined on net book value. Well, actually, typically they aren't, but net book value is when you look at a balance sheet, it's the assets minus the liabilities. That's net book value. But as I just explained a few minutes ago, the balance sheet doesn't indicate value. It just indicates historical cost of the assets that you purchased. So not too many people use net book value, except certain industries do. Certain regulated industries do, especially like banks and insurance companies. Net book value has much more meaning for those businesses than others. Net asset value is when you actually take the fair market value of assets, subtract the debts, and then you'll see that that's the way mutual fund shares are often determined, by net asset value. There's discounted cash flow. You all may be familiar with that. That's just taking the projections out, taking the cash flow and discounting it back. And then there's market comparables. And there are all sorts of market comparables potentially that could be used. In some businesses that are very early stage, they'll use as a market comp some multiple of sales. If your sales have been, say, 3 million during the trailing 12 months, maybe they'll use some multiple like 2 or 3 times sales. Usually more like 2 times, not 3. Or it may be some multiple of EBITDA, earnings before interest, taxes, depreciation, amortization, some multiple of that. Right now we're seeing that a lot of businesses are being sold for a multiple of EBITDA, operating businesses from somewhere around 6 to 8, depending on what the business is. So those are just some ways that investment bankers and investors and the market values businesses. Now here are some other terms that are important, and these terms are very relevant to early stage and startups. And that is pre-money valuation. That's simply the value of a company as a whole immediately before an investor puts in money. Pre-money valuation. Post-money valuation. That's the pre-money valuation plus the amount of money it's put in. If you have a startup that's worth $2 million, an investor is putting in $1 million, pre-money valuation is $2 million. Post-money is $3 million. It's just the investor capital plus the pre-money valuation gets you the post-money valuation. Value per share. Well, that's just the pre-money valuation typically, or the post-money valuation, depending on which one you're talking about, divided by a share number. Now, of course, what share number are we talking about? It's not authorized share numbers because that's kind of a meaningless number. Is it outstanding share numbers? Probably what an investor is typically more interested in is the value per fully diluted share. As we know, fully diluted share number is higher than the outstanding share number if there are options and warrants and convertible notes outstanding. So that term, value per fully diluted share, is very important because that will be often the number that an investor will invest on. Just some other terms here. Founder stock. That's often the stock the 2 founders have just for being there when the company's formed. If you and a partner are 50-50 owners, and if we look back at a few slides, we could see what the founder stock is. We have they both got 20,000 shares each. Once again, there's no number to that magic. Often we allocate founder shares based on them each putting in $1. So they each put in $1 and they get 20,000 shares. Those are the founder shares. Then there's a concept called incentive equity. That's typically what we call shares that are issued to employees and independent contractors and other folks that are providing services to the company. It's incentive equity. Then there's a thing called an incentive pool. And that's usually a set aside of your authorized shares where you and your partners and investors say, okay, we're going to put a certain number of shares aside and we're going to keep it as dry powder that we can issue to future employees. Say we know we really need to hire a chief technology officer. We need to reserve some shares. We haven't granted options yet because we haven't identified that person. But as soon as we bring her or him on board, we're going to go ahead and grant those. So that's often called the incentive pool, the option pool, the equity pool. It's typically something with the word pool at the end. And that's an important concept from an investor because when an investor comes in to a startup or an early stage, they want to know what equity you're going to make available to future employees. Now, one thing that's important to keep in mind is that when we talk about fully diluted shares, we said that's the number of outstanding shares plus shares underlying warrants, options, and convertible securities. An investor will also consider unused shares in the pool as part of fully diluted shares. Okay, and why would they do that? Well, of course, when you do that, that decreases or that increases the denominator. And so whenever they determine the value per share, they take the pre-money value divided by fully diluted shares, and that's the price they're going to pay. And so what they want to do is all those shares that you've set aside for future employees, they want that to come out of your hide, not their hide. And it's actually, it's a little more complicated when you don't see it with a spreadsheet in front of you. But when I sit people down and I kind of show the effect on a spreadsheet, it's insanely simple. So here's just a quick hypothetical. How much equity would an investor get in NewCo if the parties agreed that NewCo had a pre-money valuation of $12 million and the amount of the investment is $3.5 million? Well, what we have here is the pre-money valuation is $12 million. Fully diluted shares is 57,000. Now, that doesn't include an employee pool yet. We might even add to that an employee pool. So the value per fully diluted share comes out to $210.53 per share. So it's pretty simple math. The amount of the investment is $3.5 million. You divide it by the 210, they get 16,000 shares. And so on a post-money basis, that investor, that comes out to about 20%. There's a reason I'm a lawyer and not an accountant or a mathematician, because I'm not good at math. Yeah, it's like 22.58%. So that's what the investor gets, assuming that, once again, the pre-money valuation is $12 million. And really, whenever you sit down and negotiate with an investor, it's that simple. But, of course, the big issue always is, and this is always the big fight, what's the pre-money valuation? Because the pre-money valuation, remember, I stated a few slides ago, valuation is everything. Well, that ends up driving everything. And so how do we determine the pre-money valuation? And if you're involved with a startup or early stage company, a lot of people say, well, what should I use as my pre-money valuation with investors? And of course, my answer is, I don't know. But let's talk about some general concepts, maybe how we get there. And that is, part of the problem is with really early stage startup companies, there aren't a whole bunch of great market comps available. And that is, if you have an operating company, let's say an employee leasing company, there's a market out there that will price you based on your EBITDA or your EBIT or some other metric. But market comps really aren't either available or helpful when it comes to valuing startups. So, and often projections are often a wild guess. I mean, you can make certain assumptions regarding, okay, I'm going to sell this product. Maybe it's some sort of tool that some sort of app that's used in the sales process for selling real estate that I'm going to distribute through a particular market. And yeah, you could do the whole business school thing, come up with an addressable market and assume a penetration rate and come up with some projections. But those projections are often just a crazy wild guess because, there's not really a well-defined market for the product. We don't know how much marketing spend you're going to need in order to even get that sort of market penetration because we have no idea what the marketing plan for the business is going to be. So we can't really come up with projections, or at least projections are any good. I mean, you can always come up with projections. And people are paid lots of money to come up with projections, and they have all sorts of assumptions. And of course, after a year, the assumptions are way off. So a lot of times when it comes to really early stage companies and startups, the purchase price will often have no relation to valuation principles. So we kind of talked about, some businesses are valued as a multiple of EBITDA, some as a multiple of sales, some discounted cash flow. Well, you're probably saying, well, Curt, why'd you even bother talking about that if you're telling me right now that startups usually aren't valued on that basis? Well, it's kind of nice to know in the back of your mind what those concepts are. But really for startups, a lot of times the valuation is determined like that. And it's really more of this visceral sense that says, okay, I think I need $1 million and I think I'm willing to give up 20% of the company to do that. And an investor comes and says, well, I'm only willing to invest $500,000, but I want 25% of the company if I'm going to invest $500,000. Well, you have your bookends. And then there in between lies the negotiating room. And that's how typically I see startup valuations happen. So what will happen is my startup clients will do all this reading on blogs, and I tell people that they should strictly limit the amount of reading time they spend on all the startup blogs, because most of them are written by service firms or startup lawyers who are merely trying to get business. And some of those blogs, not only do they state absolutely incorrect stuff, some of it is merely meant to kind of whet your appetite and hire them as a service provider. And some of it just really isn't applicable to the day-to-day world of a true startup. So you may see out there that you need to negotiate with an investor over pre-money valuation, and these are ways you could determine a pre-money valuation. And you should keep rough metrics in the back of your head. And maybe there is some basis for saying we can get comfortable with projections, but ultimately at the end of the day, I have found that 90% of the time, the valuation decision is just some sort of gut feeling. And a lot of the gut and different factors play into the gut feeling. Some of it is if it's a software product or an app, how far along are you in development? And some people have the greatest looking business plan for something they haven't even written one line of code for. Well, that's not going to command a huge valuation because that's nearly usually the value of an idea. And some folks have a product that's been through a beta and has done some testing and some tweaking and shown some market validation. Well, that's completely different. And so I find that in a first kind of a seed round for startups, I'm typically seeing valuations somewhere between 750 pre-money valuations, 750 and, or actually more like 500 and $1.5 million to 2 million. And a lot of that depends on really the people involved. And that is if you've kind of done this, been there, you're going to get a higher valuation. If all you've done is read a few TechCrunch blogs and come up with an idea and prepare an executive summary, it's just, an investor is not going to see much value there, even if it's a phenomenal idea. It's just the reality of it. So parties often back into a valuation based on gut feelings, but keep in mind that valuation does kind of become a baseline. And that is whenever you go to raise the next round of money, people are going to look back and say, hey, what was your pre-money valuation during the first round? So the art of negotiating with your second investor is going to be like, yeah, well, this was the status of the company back when we got our seed round, but look at everything we've done since then. We built an entire product. We were halfway through a beta. And so that's kind of the background on valuation and equity. Let's get a little more specific about really how do you really allocate the equity in a startup, and how do you grant it? First of all, granting it's easy. Granting it is a board resolution saying we hereby grant Curt Creely 50 shares. That's it. It's granted. Fill out a stock certificate. You don't need to order some. There's all sorts of companies that will be your corporate secretary that you can order a book from, pay a fee to, and they'll print you out stock certificates. You print out stock certificates on your printer. You don't need that stuff. You don't need to order a corporate book. If someone tries to sell you a corporate seal, tell them to keep it. You don't need a corporate seal. You don't need to pay for that stuff. So, you have two founders. So say we have three founders. How do you allocate the equity among those three founders? Well, it's really going to be based on a relative value of contributions. If you have one founder that really has kind of a day job for 40 hours, is going to be spending a few hours at night, where you have another founder that's going to be putting in substantially all their time, well, the relative value of the contributions may differ. And the relative value depends on, the value of someone that can actually code compared to the value of someone like me. Well, it's way different. The guy codes is worth a whole heck of a lot more than I am. So his contribution or her contribution will be greater. So, what's the right answer? Well, it's whatever the three founders agree to. And a lot of times the important thing is not even the initial equity breakdown. It's what do you build into the documents, into the arrangement, if things don't go as planned. And that is, what if the person who was supposed to put in 30 hours a month, was supposed to write code, suddenly gets a new girlfriend and he's going out on weekend junkets all the time and he's behind schedule? Well, then you need to do something to kind of equalize the equity. And so one of the things you'll often hear are vesting provisions, and that is we'll subject your equity or each of the founders' equity to vesting, and that is you kind of got to earn it over time. And that is earning it could be, hey, you're still around a year from now, so therefore you've earned 1/3 of your equity, or earning it could be based on certain milestones, certain deliverables you need. Also buyback provisions, and that is if you have a partner that was a great partner, but she meets a new boyfriend and they decide they're going to run off to Belize and you can't get a hold of her. Well, you want those shares back. People just kind of assume, and I get this all the time, unfortunately. People come to me and say, well, I haven't really seen my partner in 6 months, so I can get her shares back. I'm like, no, not unless you have some buyback right or there's some vesting provision or something. Once a share is issued, you just can't willy-nilly take it back. So you need to build that into the founder documents, and so you need to put vesting provisions and buyback provisions, and we'll talk a little more in detail about those shortly here. And the one thing to keep in mind is be very careful when you talk about granting equity. I have a recent client man, great guy, great idea, but you know, I call him Mr. Equity. And that is, every time I see him, he goes, yeah, I was out with so-and-so, and I told me I'm going to give them 2%, and someone's going to get 3%, and I told someone else if they build a Bitcoin interface, they're going to get 5%. All that. You can't just grant equity. Keep in mind that if you receive equity in exchange for your services, that's taxable income based on the fair market value of that equity. Just because you're not receiving cash, it doesn't mean that you're not receiving income. You're receiving in-kind income, and that income is taxable in the year of receipt based on the fair market value. Now the question is, what the heck's the fair market value? May not be much. So therein lies one of Curt's rules, and that is grant all your equity when it's not worth anything. And so what I do is I say, assuming that these group of people, you have some service providers, maybe you know, a little design firm that's going to design a front-end interface, and then you have kind of a CFO who's keeping the books. Assume that all these people do their jobs and that everything goes in plan. What percentages do you want all these people to own? And we're going to give them all their equity up front and retain the ability to take it away if we don't get what we want. Because what happens is, as a company goes down the development path and starts to build value, of course every share is worth more. Right? The pre-money valuation goes up. It's worth more. So what you don't want to do is you don't want to grant an equity to something, and this happens all the time, where 3 years in, some chief technology officer comes in and they throw a bunch of shares at her or him, and they come to me after they did it, and often it's after the tax year, so we can't undo it. And there's a tax obligation. Now, of course, then you have to figure out, well, what exactly is the tax obligation, because there's not a well-defined value. And so then you're stuck, well, do we want to make a guess and hope we're right and hope that the IRS doesn't come and point a gun to our head, and when we sell out, you know, like Facebook in 2 years for $1 billion, then you're dead because you're going to pay all these fees and penalties, assuming that your value is a lot more. Or you can spend some money and get an independent valuation. And the IRS is forced to respect that independent valuation. Lots of good little valuation firms that will do that for you. The running price right now is somewhere between $4,000 and $6,000 typically for a simple deal. And once you start to get a little bit bigger, you're going to have to start getting a valuation. And once companies that have more than just some minimal amount of value, because they want to grant equity, they need to get a valuation. And I'm kind of glossing over a lot of stuff. But say 3 years down the road, you do have that chief technology officer come in. He goes, I want equity, but I don't want to pay taxes on it. What you do at that point in time is the way you make his equity worth zero for tax purposes is you grant him an option to purchase a share at whatever today's value is. So in the future, as the value increases, you know, if the company's worth $3 per share right now and you grant him an option of $3 per share, it's worth nothing, right? And so then you don't have to report anything for tax purposes. But if there's any delta between the value and the exercise price of the option, then that's gain, and that creates all sorts of problems. So what we routinely do is we grant equity to those folks at a price based on the value, and so companies will typically have to go get a valuation at that point in time. So you need to be, that's a really long-winded way of saying you just can't go and give out equity like business cards. You just can't go shove, you can't start printing out stock certificates, giving it to people. It creates problems, especially creates tax issues. So granting equity to key team members, like I said, this is generally called incentive equity, and you can grant equity to employees, contractors, directors, sometimes vendors. That happens a lot. It seems like, especially in the bioscience area, a lot of clients I have, you know, aren't flush with cash because they're going through clinical trials, and they have these, you know, these vendors, these advisors that help them get through the FDA clinical trial process, and So when they run out of cash, sometimes the vendors will accept stock or a combination of both, so that's very common. And once again, whenever you grant equity, though, you need to clearly define and document what's expected of the grantee. And typically what I say is, okay, if you're granting equity to, say, some independent contractor who's an advisor who's done a bunch of stuff, but it's a continuing relationship, they're going to do more, you kind of have to divide the equity into chunks. And that is, okay, what portion am I granting for stuff they've already done? And what portion am I granting for stuff they need to do in the future? And then the future part, I need to subject to vesting conditions to make sure that they don't get vested in that equity until they actually perform what I want them to perform. And, you know, that's typically, so some portion of the grant will be immediately vested, while another portion will be subject to vesting, and that's just subject to the negotiation of the parties. And the last bullet here is, don't forget, equity grants are taxable income in the year of grant. So what we want to do is we want to grant equity so that it has zero value in the form of an option, or in a limited liability company, there's a thing called a profits interest. It's really a simple concept, but it's a simple concept, but it's kind of difficult to explain. But essentially, it's almost like a share of stock that's just like every other share of stock, but it's a membership unit, just like every other membership unit, and it has all the same rights, except that when the company's sold, some portion of the sales proceeds don't come to you, and it's whatever the value is. That's kind of what a profits interest is. And so in a limited liability company, whenever you want to grant equity to a bunch of different folks, we use these things called profits interests. And you know, the tax lawyers have a cottage industry of granting profits interests, and I somehow, you know, and maybe they say that about securities lawyers like me too, but you know, the IRS and the tax lawyers, they're all in cahoots because they just create these crazy complicated concepts that, of course, then, you know, startups, a company that's flush with cash is easily able to deal with the regulatory issues. But it's it's something that you actually have to pay lawyers and advisors to deal with whenever you're a young startup. Here's some other issues that come up. How much equity should I give someone such as a CEO, a director, or chief scientific officer? I don't know. You can always, you know, you can go out to the blogosphere and see people have rules of thumbs. Someone may say the CEO should have 10%. But, you know, sometimes the CEO is so important, he'll come in and, I don't want the paltry 10%. I want to earn into 20%. Or sometimes, you know, the company's far enough along and has built enough value, you can negotiate 5%. So there really are no answers. But it's kind of the rules of thumb. You see a CEO maybe somewhere between 5 and 10%. A director, you know, I'm thinking 1 to 2%. A chief scientific officer, depends. If it's a science company, they can get more than the CEO. You know, if he or she is more important than the CEO, particularly as it comes to product development. So there are no right or wrong answers, but what you do want to keep in mind is you do always want to keep in mind how much of a set-aside, an equity pool, should I really reserve for folks like who come down the pike. And by the way, one thing I will point out, this is completely off topic, but I'm so convicted of this. We talk about issuing directors 1%. So many times, early stage companies and startups come to me and say, you know what, there's this lady who she's just a hot shot in the industry, and she's offered to be on our board. And we're going to give her options, and you know, we're going to get so much value. She's going to introduce us to potential customers, different marketing channels. And they come to me and says, well, you know, Curt, do whatever you do to the resolutions to have her admitted to the board. My rule is the board should always be as small as possible, because the board of directors, that is the governing body of the company. And do you want, say, for example, you have a partner. Do you necessarily want this woman to be a swing vote between you and your partner? Do you want her to have that sort of authority and control? She would be a great member of the board of advisors, which is not a part of the board of directors. And you know what? You can invite her to all the board of directors meetings. You can get her input till the cows come home. But there's not necessarily a reason to actually put her on the board of directors. You give her the same amount of equity as a director. but just have her on the board of advisors, which means that she really has no authority to bind the company, has no control, doesn't have a vote, but you can make as much use of her as you want. And so I have seen some really kind of bad situations where people have brought in direct celebrity directors, and those celebrity directors have really kind of taken over the board and become like a tyrant. So keep that in mind. Let's see, we have 2:49. I'm going to try to wrap it up here. I know I talk a lot. Another few things to keep in mind. A lot of times people come to me and say, hey, I'm bringing someone in, I'm going to give them a portion of my equity. You don't give them a portion of your equity. The company grants new equity. So don't think that you're ever, of course, whenever the company grants new equity, by virtues of the law of math, i.e. there are a larger number of issued and outstanding shares, you're going to dilute yourself, but it's not like the stock's coming from you. It's coming from the company. If it comes from you, then it creates all sorts of weird tax issues. And that's the same as bullet point number 2. And then actually we talked about bullet point number 3, grant equity early. Just a few note about investors. Whenever you issue equity to investors, they're typically going to want a preferred security like preferred stock, which essentially means when the company's liquidated or sold, they get their money back first, plus maybe some sort of preferred return. So there are things called like liquidation preferences, distribution preferences. Those are different things. You often hear the word anti-dilution rights, and sometimes someone will come in and say, hey, I'll put some money in, but I don't want to be diluted. We're going to talk about in a second what that means. It doesn't mean what a lot of people think it means. Let's skip the last bullet point for now. So let's talk about the D word, dilution, because it's the word that everyone's always scared about. And people will say, well, I want to do this, but I don't want to be diluted. And I often ask people, well, what do you mean by you don't want to be diluted? And then they often can't answer the question because they think about, well, I don't want my percentage to decrease. But by definition, if you're issuing more shares, your percentage is going to decrease, right? So here's some possible meanings of the word dilution. One is dilution in your ownership percentage. Every time the company issues a share, you're diluting your ownership percentage. Kind of obvious, right? Dilution of net book value per share. That is when you look at the balance sheet, whatever the assets minus the liabilities are, that's your equity. You could be that divided by number of shares. Every time you issue a share, there's dilution in net book value. There can be dilution in net asset value every time you issue a share. There can also be a dilution in earnings per share, and that is if your company has earnings, you take the earnings, divide by the number of shares. The more shares you have, obviously there's less earnings per share. And then there's dilution in economic value per share. If essentially your share's worth $5 million right now, or $5 right now, and you issue a share at $3, when you there's economic dilution because you're issuing equity at a price lower than what you got it at. A lot of people think that dilution is the first bullet, and that is ownership percentage. No, that's not what people usually talk about. They usually talk about the last one. And in fact, people talk about, I want protection against dilution. The first one I might call percentage guarantee. So, someone may say, well, if I put in $100,000, I want to make sure I always own 10% of the company. Don't ever, 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 ever grant a percentage guarantee. Ever. I mean, I guess unless it's, you're on death's doorstep in terms of the company, because it's completely irrational. So the person who invested $100,000, say at $1 a share, at an early stage in the company, you help create all this value, and you end up selling shares, say, $10 million worth of shares at $100 per share. That's economically accretive to that person, but it substantially dilutes their ownership percentage. So what happens is if you give them that 10% protection, they're basically getting a windfall that they don't deserve, and it's coming out of your hide as a founder. And once I show people kind of on a spreadsheet the math, they look at that and they say, that makes absolutely no sense. Because what happens is it almost penalizes you the more successful you are. So don't ever grant a percentage guarantee. Interesting side note, I had a client that was making an investment in an early stage energy company. And he says, I told them that I want to make sure I always own 20%. I'm putting in $1.5 million. And I said, they're just not going to agree to that. I said, because it's illogical. He goes, that's what I want. And after several meetings, I explained to my client, well, let me explain to you why this is illogical. It doesn't make sense. It kind of penalizes the founders. He goes, I understand. Yeah, you're right. It doesn't make sense. But I still want it. So we went to the other side. And, of course, the attorney came to me, and I had to deliver the message. The attorney on the other side, and the company says, are you crazy? We're not going to grant you a percentage guarantee. He goes, you know that's illogical, don't you? And I says, I don't know there's any point to argue about logic. That's what my client wants. You could take his money or not. And so he went, with me through the same exercise I had already gone through with my client. And to this day, in 20 years of practicing law, he's the only person I've seen actually get a percentage guarantee because they wanted his money so badly. Now, of course, what it ends up happening is it can't stay in place. Once the company grows, you have to come back and negotiate with that person. Because when a real investor gets in there and they say, you grant a what? A percentage guarantee? So a lot of people think that's what a dilution protection is. It's not. It's really protection against dilution and economic value. So what investors are really worried about when they seek anti-dilution protection is they want protection against the down round. And that is, I invest at $5 per share right now. I don't want you turning around and selling stock at $3 a share to someone else. And so what the kind of the basic anti-dilution right would do is it would say, when I would say, okay, if you issue shares at $3 after I paid $5, my price goes down. And the price can go down by an adjustment in the conversion price or by issuing me more shares. But that's what's called, that's what we call full ratchet anti-dilution right. And actually, as indicated in the third bullet point, anti-dilution right is not really a good word for it. It's really price protection. The price you're paying is getting protected. You're being protected against down rounds. And there are actually two different types of price protection anti-dilution rights. One's called a full ratchet, and that is whenever the company does a down round, that is a round of financing at a lower price per share, your price goes down to whatever that price was. And there's something called weighted average, which basically says your price goes down, maybe not all the way down, but it goes down based on the relative sizes of the financing. So it kind of goes to economic dilution. These are things that keep first-year securities lawyers busy for months. So there's no you don't need to understand them in any great detail, but just kind of understand anti-dilution rights do not mean a percentage guarantee. Let's move on after this. Yeah, you'll see protection against dilution and percentage ownership doesn't make sense and is unfair. Let's spend 2 minutes talking about equity agreements. So we talked about lots of concepts, and a lot of these concepts are built into equity agreements. Equity agreements, there's usually, I've never prepared something called an equity agreement. Usually it's part of a stockholders agreement or a founder agreement or an operating agreement, but there's just a variety of type of agreements that you can incorporate equity terms into. And in limited liability companies, everything's in one big operating agreement. It's usually like 40 pages. Your eyes will glaze over when you read it because it contains like 10 pages of tax boilerplate.